What's up, everybody? Welcome to the Free Toaster News Podcast. I am your host, Carlos Caro. I'm here with Free Toaster co-founder, Nick Madrid. In our pod, we cover one or two stories from our weekly edition of our newsletter. It publishes every Wednesday at thefreetoaster.com. We cover stories at the intersection of consumer lending, technology, and marketing. Before we cover our feature story for the week, I want to thank our sponsors, Spinwheel, Bulldog Media Group, and Fintel Connect. Nick, this week our feature story is the Q4 2025 earnings report from NerdWallet. And we're staring at the numbers here. They did $209 million in revenue, up 29% year over year, and profitable. And this is under a backdrop of their SEO business declining, just given all the headwinds with Google. And we've talked about these headwinds before, but the gist of it is a lot of the publisher traffic across the industry, this isn't NerdWallet specific, but the bank rates, the points guy, everyone's feeling it as traffic migrates from Google to the LLMs and AI. And a part of me starts looking at the headline, wants to tip my hat to the operating team at NerdWallet because they found a way to grow 29% year over year with really, really tough macro conditions. And then a part of me has a bunch of questions because as I unpacked the business units, and we're going to look at cards and insurance and small business, and we'll peel the onion here. It's a little puzzling how this is all coming together, and I just wonder if these kinds of results are going to be sustainable from their business. So before we go too far down that path, what have you noticed, Nick, as you dug into the earnings?
Yeah, and I can't help acknowledge, like, you're in the United Club right now, or you're in an airline club right now. You had a great event last night with the Free Toaster. Maybe we can get to that as well. So if we hear some background noise, that's where we are right now. So also want to tip my hat to NerdWallet. In their quarterly reports, they do a great job breaking down the different business lines. It was just giving us so much visibility and understanding into their business, whether it's their insurance line or their credit card line, their SMB line, or their loans, or their emerging verticals. So on one side, I'm so glad that they give us visibility so we can unpack it, but I can't help but share my disappointment because in their transcript, and I'm going to quote this is from the CFO, moving forward, we will simplify our revenue reporting from 5 categories to 2. Consumer and SMB. Consumer will combine what we will currently report as insurance, credit cards, loans, and emerging verticals. SMB will continue to report it as of today. Our consumers and SMBs often engage with us across multiple product categories, and we believe this presentation will better reflect that reality. We have provided historical data restated under the new revenue categories to facilitate comparisons. Oh, Carlos, I'm so bummed. I think we're going to lose all this visibility. I just can't help but ask, like, why are they doing this?
Look, I get it. They're one of their probably peers in the category, Karma. When they report out through Intuit, they do the same exact thing. They report Karma as an entity. They don't break out cards. They don't break out personal loans. And I think part of it has to do with when you work with large banks, large revenue partners, part of it is you want to be cautious around how much transparency you give those partners around how big and how important they are to you. Because if a partner knows they're really critical to your revenue, now they can lean into you and try to negotiate and do all sorts of things. So, like, having worked on the publisher side, I'm highly empathetic to that concern. The other reason they could be doing this, Nick, and we'll maybe flip to a chart from our newsletter. Hopefully this is visible enough to you where you can kind of make out some of the lines. But their cards business was in, let's call it the mid 50s. If you look at the Q3 2023 data point, that purple line, and it's really tailed off. It's probably in the mid 20s. So that card business went from, call it 55 to 25 million. So it's down over 50% in less than 3 years. That to me is really closely correlated with the SEO reductions I've been studying. So as I go out and I look at domains in the category, like how much traffic have they lost because of the SEO disruption? It's roughly in that 50 to 70% range. So to me, Cards is tracking exactly with the organic business. And maybe they just don't want analysts poking at this, Nick. Maybe it's just like, look, we found insurance. You can see insurance has rocketed, and it's now their largest vertical at 80 million. And if they roll up all of consumer, they just don't have to answer all those questions about search and get into these weeds that honestly could feel a little bit could put them on the defensive. So I wonder if that has to do with it.
I can't help but think that. Let's unpack this paid versus organic. I want to quote again Tim Chen in the earnings transcript. So in 2025, we face headwinds across consumers increasingly turn to AI overviews and LLMs over traditional search, resulting in steep organic search declines. Clearly, if there's anything that gets across, we all should know that. But maybe you can help me unpack this idea of this shift from organic to paid and some of the nuance there. I'd assume you're more of a practitioner. Like that's an incredibly hard shift to do. And I'm going to find the other quote while you kind of chime in here. But they're more worried, I think, in getting the channel going than optimizing for margin. So I want you to chime in here, and I'm going to go find that quote for you.
Yeah. So on the whole search to performance transition, let's talk unit economics first. So the really nice thing about organic is it scales really nicely over time. So as you build domain authority and people start associating your brand with the category of product that they're searching for, let's just say credit cards, for instance, it has a nice way of compounding so that the number of writers you have to hire and pay to produce content can reach more and more people over time as your brand equity and your domain equity rises. All that to say, the margins at scale and SEO for a business like NerdWallet look really, really attractive. On the paid side, however, especially when you're new, you're coming in a category like cards that's ruthless. It's really cutthroat. It's really competitive. And as NerdWallet, you're getting a commission from the card issuer. And let's just put some numbers to it just to make it tangible. Let's say you get a $200 commission from an issuer. That issuer's lifetime value on a card holder might be $1,000, right? So if you were a card issuer bidding on a keyword in search, you might be willing to pay way more than an aggregator like NerdWallet because your unit economics are very different. You have much more upside when you close a deal, which makes you bid more aggressively. The counterpoint to a marketplace is they have a lot more offers. So when a customer clicks in, they don't have to pitch the customer one brand or one product. They could pitch 20, 30 products and have the customer pick the best one. So generally how this works is marketplaces convert more. They have like a higher take rate because there's more options, but then their unit economics are slimmer. Net though, I think it's actually quite hard, especially when you're new, to go up against the giants, the Capital Ones, the Chases, the Amexes, who have been dialing in paid search for decades. And you're coming in Q2, Q3, your second or fourth quarter going at it. And you're trying to not only gain share, but also make it profitable. So that to me is the explanation for why cards continues to decline. Because I think they've probably realized if they do paid search and cards, it's going to be break even or maybe even negative. So they've let that business kind of tail off. And for whatever reason, insurance is the place they've leaned into. But I have friends in the industry. I've been having informal conversations about insurance. And what I've been hearing from folks from industry is that sites like NerdWallet that are aggregators tend to be the incremental lever that big carriers lean into when they need extra account volume. So they'll go from not investing very much at all because they have all sorts of organic channels and first party channels, to saying, actually, we need to hit a number now. And when they need to hit a number, they can go pretty wild and lean in aggressively into aggregators. Um, but it runs these kind of hot and cold cycles. So just like a recent example, a little bit post COVID, aggregators went pretty hardcore into third party marketing. And then as the Fed started changing rates and like that 2022 downturn started to happen where the stock market dove and all of that, the carriers pulled back materially to the point where some people in the business of aggregating insurance actually went out of business. Um, and then it's picked up obviously since in the last couple of years. So the question I have about the results NerdWallet presented is how sustainable is this? Because I haven't seen them bend the curve yet on cards, which like used to be their top revenue driver, and now insurance has picked up a really healthy share of the business, but it's not clear how much of this is just like a cyclical, opportunistic thing they're grabbing from the market versus something they can sustain for years and years on end.
Yeah, it's interesting because there's a few more things that I want to read for you and get your take on. One is that one of the Morgan Stanley analysts, asked John. Basically, it was how do you address the SEO headwinds? And he said, first of all, we're not solving for a margin percentage. We're focused on adding NGOI, so non-GAAP operating income dollars. Given the mix of changes in performance marketing and organic revenue, it tends to be not as correlated to NGOI and free cash flow. And then focusing on margin percentage targets will be limiting to our flexibility as we need to make the right economic decisions for our shareholders. So you and I were discussing earlier, I think this means they know they need to switch away from organic to paid, and they just need to get it right and humming. And they're not worried about the underlying economics necessarily underneath it. There's a few other things I want to read for you and kind of get your take on it. In the Morgan Stanley report, they make a great point in terms of investors are having a hard time grappling their head around how do we handicap the pace of organic search decay and the profitability implications of the incremental growth that's increasingly being driven by performance marketing, which inherently becomes progressively more expensive at scale. So there's like a lot of things moving that it's really, really hard to get right. And I'm going to leave you with one more quote, which I think is just so interesting for us. And it has to do with, our first quarter guidance assumes similar trends that we saw in the fourth quarter. Revenue growth by an increase in performance marketing revenue, which we've talked about, outweighing organic revenue headwinds, which we got. And we expect the margin compression caused by this ongoing revenue mix shift will be offset by year-over-year declines in brand marketing spend. So add another challenge to this. They're actively saying that we're going to remove spend from brand to kind of help account for all this. So what's coming on your?
Oh man, that one. There's a lot there. The thing that stood out to me is the thing you said right at the end of we noticed we noticed margin compression, probably for the reasons we talked about earlier, where organic and paid have very different margin profiles. And in the short term, if you're trying to put up a better net income or margin number, it would make sense you would pull back on brand, because brand dollars that you spend today manifest in conversion rates 12, 18 months out. There tends to be a really big lag between brand advertising and results. So from a short-term optics perspective, I think it's logical if you need to hit a margin number for whatever reason. As a marketer, though, I really get nervous around a position where you're divesting from brand, particularly for someone like NerdWallet. Like their whole story historically has been brand. Great content, great brand, people searching them out specifically, trusting their content above others. So as soon as you start to pull back the brand, it's going to make your margins look better in the short term, but I worry about top line reductions 18 months, 24 months out. So if you're telling me this is a 6-month pullback, and then they're gonna re-enter with a renewed strategy or renewed energy, I can get my arms around that. I'm not super worried. But if it's You said year over year, like it's the way you said you read the quote sounded like there's an expectation that over years they're going to be declining on brand, which um, that makes me nervous for their long term top line performance.
Yeah, let's not forget about a year ago, a little over a year ago, they had the huge brand spend at the Super Bowl. Um, I'm looking at an Adweek article from December 24, and basically the brand money experts said big game ad from Deutsche is worth is it worth a 7 million media investment? So it was at least 7 million plus, right? I'm sure we can find the number in the financials. So in theory, those should be coming to life, now and in the next 6 months. So maybe that has helped them, and this is a halo effect that they say that they have, and like maybe we're seeing. But like you said, like you're just um, kind of moving investment from the future, and it's tough. This is not an easy game for
No,
sure.
no, this is really tough. I'm really empathetic to the position they're in because they've been investing in this for I want to say close to 2 decades now. They've been at this for a while. They've built one of the top brands in consumer finance, and they had a really strong business that was trending well for many years, and all things considered, still trending well. The question is how sustainable, right? And the one of the things that would help me get tighter on my personal point of view is to talk to someone that's worked at another aggregator that has worked with insurance carriers because I want to qualify and put a finer point on the thing I said earlier of like carriers being hot and cold with third party advertisers like NerdWallet. If that's true and this is like a cyclical thing, it looks like a sine wave because they need accounts and then they cool off and that's just the way it's going to run forever. I'd want to know where are we on the sine wave as it pertains to NerdWallet's results because that would help me contextualize this a little bit better. So I'm hoping I've actually reached out to a few friends, Nick, in the industry, one of whom works at an aggregator like NerdWallet that works with carriers. In fact, their business is entirely insurance. So they don't do cards, they don't do loans, they do only insurance. And I'm hoping that individual can help us make more sense of the numbers.
That's great. I don't think we have enough time, but to continue this conversation. But let's do this. If you get, let's say, 5 or 10 people that raise their hand and want to hear more, and even deeper dive on NerdWallet, let's do that like next week. And I think one of the areas we could kind of talk about next week is this idea of LLM based referral traffic, which they've mentioned a few
Yeah.
times in their transcript.
Yeah.
They say that it's greenfield. It's clearly an opportunity for them. They say that while the numbers are smaller, much higher intent for those referrals that come through that. So I do think that's an area that we could unpack. If you get enough interest,
Yeah.
I'm game.
Yeah. No,
So
I'm glad you brought that up because to me, there's probably a moment in the next, let's say 4 quarters, because I've heard the narrative of, yeah, search on Google has gone away, but it's not like humans aren't searching. They're still searching. They're just doing it in different places, right? They're doing it in ChatGPT and Claude, et cetera, et cetera. So the behavior is still there. It's just being captured in new places. And I do think in that environment, in an LLM environment, your brand equity matters a lot because when you do an inquiry to ChatGPT, you're going to say, "Hey, I want the best credit cards, but can you give me NerdWallet's take?" If that's a brand that's cemented in people's brand as a trustworthy authority, individuals are going to start asking for the NerdWallet take. So I could see the credit card line start to bend and start to grow again if they're successful in capturing that traffic, which I've heard that argument be made. I just haven't seen it in their data yet. But to your point earlier, Nick, if we're going to lose the granularity on cards and insurance and the view we're staring at now, we're not going to be able to see it as clearly as we do today. And that might be by design because they don't want too many microscopes on like the weeds of their operation, which I can empathize with that as well. Nick, I do want to show
thanks,
you
Carl.
I want to show you one more thing. It caught my eye, and I want to get your reaction to it. Let me find it. It's their R&D spend. Can you see that?
I can.
Yeah.
Yes.
So 7%. So this isn't like it's not like a huge deal. It's only down 1%. But in the face of everything that's changing right now with search and like the core of their business, you would think they'd have a more deliberate effort on research, R&D. Actually, this is G&A. I'm sorry. Let me find the right chart. Here it is. 9% going to 7%. So I would want to see this increasing because there's a lot of new stuff going on, and I would expect them to be investing in new discovery formats and new ways to connect customers to lending products. And I think this would sit in R&D, but maybe this is just an accounting thing of they're doing all the work, but it lives somewhere else in the P&L. I don't know. Do you have a take?
I don't know if this is a take, but one of they have three core growth strategies, and one of them is actually in acquisitions, and they have a pretty big balance sheet. I want to say like close to 100 million in
That's
cash.
right. Yep.
I'm trying to bring up the balance
No,
sheet
that's
real
it.
quick to see.
I think that's spot on. It's like
Um,
98 million or something.
so perhaps maybe they don't feel like they have to do internal R&D. Maybe that's not a core competency, and they're maybe classifying it as we can just acquire our way into this. Just an idea.
Yeah.
No idea if there's how strong our foundation that is. Great to talk to you, Carlos, but I can't let you go. You have to let me know how the event was last night. New York City, amazing steak, direct mail as a growth channel. How was it? I'm sorry I
No.
missed it.
Yeah, no. Yeah, it was a bummer to not have you. We were probably as far as we could have been within the continental U.S. But no, it was fun. We had. I mean, I'm still sitting in the United Lamb, so I'm still here in New York. I'm about to fly back to DC. Hopefully, this episode will be live after I'm already home. But we were in a steakhouse called Jack and Charlie's in the village. We had a private room. We had 16 guests, and we talked about direct mail marketing was the prompt for the evening. The event was sponsored by ICS Corporation, so it wouldn't have come together without them. But we had scheduled 3 hours of conversation on best practices, what's working, what's not working, specifically in direct mail. And as you might expect, Nick, the conversation veered into all sorts of other places: affiliate marketing, AI. I think I could probably do a whole podcast or a long form piece on all the things I heard from the evening. And in fact, I plan to do it. But it was super cool just to talk to people face to face. We rotated tables a few times, so we got to meet a lot of different faces within the 3 hour block we had. We ended up hanging out an extra hour at the restaurant. I started noticing the wait staff was, starting to give signals that maybe we should go somewhere else. So there was an after party at an Irish pub down the street where we went till about 11 o'clock. So we were hanging out from 5:30 till 11 o'clock. And I got made some new friends, made some new connections in the industry. I had a really good time.
And you were talking about direct mail the whole time. That's insane. That's incredible, Carlos.
Like I said, I'm gonna write up some of and Amanda was there too from our team, and I actually just saw she dropped in Slack a whole bunch of notes that she took. So we're gonna be debriefing with Dennis and John from ICS, and I asked them at the after hour. So they might have had a glass of wine or two in them by this point, so I'm not gonna hold them to this if they change their minds. But they agreed to come on the pod to give us their take of the evening. What did they hear? What were the big questions they heard from lenders? What were the big themes? They're the pros in the space. They know way more about this stuff than I do. So I'd love to get that interview. And Nick, hopefully we can bring you on the pod and we can do that little jam.
So there's that, and there's also, I think if we get enough interest, we can do a similar thing on the West Coast because you have a few trips out here. We can also do a direct mail call it summit, direct mail, dinner in the West Coast. So also, if you're interested, if you didn't get a chance to attend the New York one, let Carlos or me know, and then we'll make it happen on the West Coast.
That'd be awesome. We were already brainstorming what other cities we might want to do this in. SF came up, Chicago came up, Philly/Wilmington, Delaware came up as well, because there were a fair amount of folks that traveled. Actually, we did a little bit of a survey, and of the 16 guests, I think 6 were local to the New York area. Everyone else traveled to a town, which I didn't really notice until we did the informal survey at the table. So that was kind of cool.
That's incredible.
So Nick, if we don't wrap soon, I'm gonna miss my flight. So I'm gonna call it a pod, and look forward to talking to you next week.
Thanks, Carlos.
Okay,
bye.
Bye.